Do you want to send this link to everyone? Hello, testing. I think it's working. Okay, yes, we are live. Let's see, testing. Okay, cool. All right, we had a little bit of a glitch here with our, we had to relaunch it. Sorry about that. So we're gonna wait for a few people to join us live. But meanwhile, so we are in the month of November, and this is to a lot of people, a lot of business owners think that right now is the right time to do tax planning and signing up for tax service and hoping that they can save money on taxes. Let me tell you something, that hope, okay, hope is not a tax strategy. Although there is still a number of things that you can do in the month of November and in the month of December to save money on taxes, you should still be proactive and start doing your tax planning in the beginning of the year, because the amount of deductions that you are missing out as a business owner throughout the year is way more than when you just start doing planning in the month of November. We had a prospect or somebody who wants to sign up for our services, and he's like, yeah, I just want to know if I'll be able to save anything this year. Well, I don't know. Where have you been this whole 10 months? Okay. So I said, well, I know for sure that if you sign up right now, you'll save a lot of money for 2024. 2023, it really depends. So I want to dedicate today's live about last year, last minute, so to speak, tax strategies that you can use as a business owner. I'm just going to go walk over there, bring my whiteboard. I'll be right back. Cool. All right, awesome. So for those of you that are joining us live, and if you are a business owner, please, I ask you, ask tax questions. Right now is the best time for you to ask tax questions, because we're going to strategize on your taxes to make sure that you're paying the bare minimum in taxes. All right. So for those of you that are watching a replay on this, now let's cover year-end, right? Year-end tax strategies. Now, first, I want to talk about S corporations. There's a number of business owners that I have spoken to in the past month that have an S corporation, but they do not have a salary. Okay? They don't take any salary from the business. And if you're not sure whether you are that individual or not, whether you take a salary or not, what I want you to do is look on your Form 1120-S, which is the S corporation tax return. Look on line 7. One of the things that IRS is after auditing, okay, is officer compensation, officer reasonable compensation for S corporation. So if you've got a profit, and we actually just got a new client who has $193,000 in profit on the S corporation, but line 7 is 0. There is no salary. Okay, so it's really, really important. Now you might say, well, Boris, how is this a year-end strategy? Believe me, this is going to save you a lot of agony. Okay, and if IRS does audit you, and if you don't have a salary, and if you took $193,000 fully in distributions, IRS is going to add it back as a salary. And guess what? You're going to end up paying Social Security and Medicare taxes on everything that IRS recategorized from distributions to a W-2 income. So that is super important. Let me just grab the eraser. Yeah, that is super important. Okay, so that is one of the year-end tax strategies. Now you might say, well, Boris, if I do run salary for myself as an S corporation, which I haven't done this entire year, can I still do it? How do I do it? And will I pay taxes on it? Yes, you will. Okay, so let's assume you're going to take a $100,000 W-2. And you may say, Boris, I don't have $100,000 in my business, okay, to pay, excuse me, to pay myself on a W-2. That's okay. You don't actually physically have to transfer the money from the S corporation to your personal. You just have to run a payroll transaction. This would be a paper payroll transaction. Okay, that's what I like to call paper payroll transaction, to show that you did take a W-2, a compensation from the business. Okay, now and then you are, of course, going to pay Social Security and Medicare taxes. And the Social Security and Medicare taxes will be 15.3% on this. But you might say, well, Boris, why would I want to pay $15,000 in taxes right now? Because if you don't, and like I explained to you before, if line 7 on your S corporation tax return is 0, this is going to be picked up for an audit. And then everything that you took as a distribution will be added back. A lot of business owners don't talk to their accountants about this, okay? Because they don't have a tax advisor. You need to make sure you work with a tax advisor. This right here has to be analyzed on an annual basis. Now, I know we have a couple of questions come in. We're going to get to your questions in a second. Let's talk about the second thing. By the way, for those of you that are joining right now, sorry we had a little bit glitch with the link. So go ahead and ask your tax questions. That is what I'm here for, to answer any tax strategy questions so that you, the business owner, can pay less in taxes. The second year-end deduction that you can do is prepay expenses. Now notice how I'm not saying go buy extra equipment that you don't need. Go buy extra assets that you don't need, okay? Now a lot of people say, oh, go buy assets. And I'm not talking about a car. I'm just saying assets, equipment. Because even though bonus depreciation is 80%, you can still actually take 100% on the Section 179, okay? Given if it's under $1 million and so forth, whatever that threshold may be this year around. But as long as it's under the threshold, then you're totally fine, okay? You can still do 100%. But I'm not saying go and start spending money to get a write-off. If you don't need equipment, please don't buy things that you don't need. Yes, you're going to get a tax deduction, but you're going to lose more money. Okay, what I'm talking about here is prepay some of the expenses if you need to. Now, prepaying expenses is not always the best option or the ideal option, because you're then robbing yourself from a deduction next year. Depending on your planning circumstances and what you need to plan and how you need to plan, reducing your taxable income this year, you may be better off. Maybe you know for a fact that you're in a higher tax bracket this year than you would be next year. So you're like, you know what? I need as many deductions as possible this year because I have income this year that is an anomaly income. Okay? So how do we do this? What type of expenses qualify? One of them, and the biggest one, is rent. Okay? So IRS says that under a safe harbor rule, if you have if any expense that has a 12-month contract, thank you so much. If you have an expense that has a 12-month contract attached to it, so to speak, that can be prepaid, including rent, office rent, commercial rent, whatever it is that you want. So you can prepay, actually you can pay it in December before December 31st. Now your landlord might be mad at you. Your landlord could be like, hey, what are you giving me all this income for? I don't want to include it as an income this year. That's okay. What you can do is send him a check. As long as he receives the money next year in January and deposits it, he doesn't have to report the income until next year in January. So he's not going to be mad at you, okay? But at least you got a prepaid expense deduction. But again, prepaid expenses or buying equipment, even if you do need the equipment, do an annual, a careful analysis of these expenses. Do proper planning. Do I need to buy this equipment? Do I not need to buy it? Do I need it? How much of depreciation can I take? Okay, let's talk about a depreciation for a second, okay? I do want to talk about that depreciation because a lot of people at the end, they buy a car or they buy equipment that they don't really need, okay? Because they want to get a tax deduction. So let's talk about depreciation. Okay, we've got two depreciations. We've got bonus. Well, really, I'm not going to say two. We have three types, right? So, which is I'm going to write the regular depreciation, which, it could be over 5 years, 7 years, 10 years, whatever that may be. Then we have bonus, which is 80% this year. And then we have Section 179, which actually allows you to take 100%. Okay? When you put an equipment, let's say you bought 3 equipments in the same class of an asset. If you cannot choose to do bonus depreciation only on one equipment and then not do bonus on the other. You're like, you know what, the other equipment, I'm just going to depreciate it over 5 or 7 years, whatever that may be. Okay? You can't do that. Once you have a class of asset that's taking a bonus, you have to choose bonus for all of it. Now, with the Section 179, I should write 179. With the Section 179, you can actually choose, you know what, I only want to depreciate 40% of this equipment and only one equipment, and the others I don't want to do. Really, really careful planning is required on your end. What's another important thing is that depending what state you are, right? So I'm in the state of New York, and there are also those in the state of California, for example. California don't like e-bonus depreciation, and New York, I know for a fact, does it, okay? So they do what's called an add back. They add it back to your income, say, hey, we don't recognize it, we're gonna play by the regular rules, okay? In New York State, they don't like bonus, but they'll accept Section 179. I've seen many times where accountants took a bonus depreciation, for example, in the state of New York, and wouldn't pay attention that that deduction is not eligible in the state of New York. Well, if you properly plan and you speak to your tax advisor about this, if you do, excuse me, Section 179, you can. Okay? Super, super important. These are a couple of year-end strategies I wanted to share with you. We've got few people on the live. So please don't just watch it. Ask us tax questions. So I'm here until, well, hopefully as long as you need me. Okay? Ask me tax questions. Right now is the perfect time to ask tax questions. Whatever your situation is before year end that you want to save money on taxes, you as a business owner, right now is the time to ask. Let's do it. All right. So I've got here, it says, Christy says, I will create a family management company for my S corporation. For that, I will need to open a sole proprietorship. My question is, should the DBA be under my son's name or fictitious name? Okay, let's answer that question. So Christy is asking a question. So because I know Christy, I know exactly the type of a question that she's asking. Okay, so Christy has an S corporation, and she has kids that help her in the business. Okay, that work for her in the business, and she wants to pay them a salary. If you pay salary from an S corporation, what you pay your children from the S corporation is still a tax deduction. The problem is because you're an S corporation, you have to pay self-employment taxes. So Christy over here is setting up what's called a family management company. A family management company that operates as a sole proprietorship is considered a parent, okay? And the parent doesn't pay self-employment taxes when paying their children. So she says, hey, if I'm going to open a family management company, do I need to make a fictitious name or under my son's name? Well, the family management company should be owned either by you or your spouse, not under your son. Because if you're doing it for the son, then it's like him getting paid 1099 income. We don't want that, okay? So it has to be a fictitious name. The EIN has to be under your spouse, and the business has to be, that family management company has to be under your spouse. Hope that answers your question. We got a comment. You're good. Thank you. All right, cool. I know we haven't been doing these lives for the past few weeks, but we're back, and hopefully we'll get back on doing it every week. So any questions that you guys have right now is a perfect time to ask. I know we kind of did this last minute, kind of shoot out an email, and our link broke. We had to do a new link. Hopefully we're still getting some people coming in here, but I'm going to stay here as long as you need me to. Let's answer some tax questions. Any other tax questions that you have right now is the best time to ask. Let's go. I'm going to give it a couple of minutes. Christy, do you have any more questions? And I got like a sore throat today. All right, cool. We got a question from Surf. Mariana, you want to read the question? By the way, we have Mariana here, everybody, okay? So she usually moderates the questions. Today's been very quiet.
Is it necessary to set up an LLC for managing a real estate property in order to get accelerated depreciation?
Okay, so that is asked by Surf, correct?
Yes.
So Surf is saying, is it necessary to set up an LLC, right? What's that? What's
for managing a real estate property?
Managing real estate property
in order to get accelerated depreciation.
So this is a very, very loaded question. So I'm going to try to break it down for you. If your purpose of your LLC is to manage the property, then the property should not be under the management company. So you want to have a property in a different entity. Okay. So let's just put a little triangle right here, and this is an LLC which has a real estate property. Okay, real estate one means real estate property. This is an LLC. This should not be also your management company. Okay. Now, if you happen to have a real estate under one LLC and you're doing management from it, it doesn't matter where real estate is held in order for you to take the accelerated depreciation. Okay. And I'm assuming you are referring to a cost segregation. Okay. Now, again, I want to repeat this again. It doesn't matter where your property is held, whether it's under an LLC, under your management company, or without any LLCs, you can still take the accelerated depreciation to a cost segregation study. What I would caution you is, please, and I say this all the time, you only want to perform cost segregation study on a real estate property if you have meet a goal and a criteria. What do I mean by that? Okay. Number one, your goal is you will not sell the property in the long term, or in short term, or even long term. Okay, sell. If you're not going to sell the property, then cost segregation is good because you're going to get all that depreciation. Perfect. But if you're going to sell the property in the near future, you will recapture that cost segregation. You will pay taxes back on it, on all the depreciation that you took. And the criteria, and this is the goal, right? Goal is not to sell. And number two, do you meet the criteria to take those losses? Because remember, cost segregation produces losses, right? Because cost segregation is done on a rental property. Rental property, by definition, is passive income. Passive income or passive loss. Passive losses can only be deducted against passive income, or if you qualify as a real estate professional. Do you meet one of those two? Do you have another passive income? Or do you qualify under IRS definition as a real estate professional? I've seen business owners watch TikTok videos, YouTube videos, Instagram reels, don't call their accountant, have no tax advisor, look up cost segregation, find the company, call the company says, yeah, of course we can do cost segregation for you. And they're rightfully so, they can say that because they're not tax advisors. They don't know your tax situation. And they say, this property is going to give you $100,000 extra depreciation deduction. And you're like, oh, let's do it. And then you come to a guy like me. It's like, Boris, I know you're a tax advisor. I did cost segregation. Take my deductions. What else can I do? You don't qualify. You don't meet the criteria. You can't take that loss. So all the money that you paid for cost segregation, the unnecessary cost segregation, that hurt you. So please make sure that you're absolutely working with a tax advisor. Don't do cost segregation on your own. Okay? As good as it sounds, and as any company you can hire for cost segregation, absolutely not until you analyze your tax situation. All right, next question, Mariana.
Next question is from Mark.
Mark, hello, Mark. Say hello in the chat.
SEP versus solo 401k.
Okay.
Which one is best, or the most I can contribute? Say 150k income. I've been getting different answers.
Mark, well, today you're only going to get one answer. I'm going to ask you. You said I have $150,000 income. Mark, I want to ask you. I see. Said Boris. I want to ask you, since you're typing. You said $150,000 income. What is your W-2 income, and what is your net profit, and what type of entity it is? Right. I'm going to wait for your answer. So, is it an s-corp? How much is your W-2 for the year, and what is the net profit of the business?
It's an s-corp.
Okay. Okay.
150 W-2.
Okay.
Dun dun dun. Profit say 300k.
Say 300. Okay, let's say it's 300k. Okay. Okay. I don't know why I'm having a brain fart. Okay. Like, I'm trying to remember the SEP. We do 25% of the net profit or W-2. Man, I think it's W-2. No, wait. 25%. Why am I did a video on this on YouTube, and I'm having such a brain fart. And I told you you're going to get an answer here, right? Damn. Okay, cool. So, but let's walk through the basics. First of all, with the solo 401k. Oh, I got it. I think I got it. Okay. With the solo 401k, by the way, I woke up with a sore throat today, okay? So I'm still here, guys. Okay. With the solo 401k, Mark, one thing you've got to understand is that solo 401k, you can put away 25% of your W-2. So what's 25% on the W-2? That's $37,500. You like how I do my math? It's quick, huh? That's why she married me. Okay, 37,500. Mark, you with me so far, right? Say I'm with you if you're still with me. Solo 401k, you take 25% off your W-2. Okay? And then as a business, this is a business contribution. Your business will contribute this. Then you can put away, I'm assuming you're under the age of 50, okay? You can put away $22,500 from your paycheck. So $150,000 as an employee deferral, okay? You can put away $22,500. So that gives us $60,000, I think. $60,000 contribution into 401k with these numbers, okay? Solo 401k, assuming you have no other employees. Now, if we're doing a SEP IRA, if I'm not mistaken, I shouldn't be mistaken. I don't know why I'm having such a brain fart, but with the SEP IRA, you can only do 25% of your salary, which only lets you to do 37,500. So as you see with the solo 401k, the idea is the same, but because you have because it's a solo 401k, you can do employee deferral from here. Hope that answers your question. Does that answer your question? Makes sense. Okay, you got it. All right, next question, Mariana.
Question from Jane. I have an Airbnb business that has been losing money this year. I am wondering if I should still pay myself management and cleaning fees, or if I should just write them off to my kids instead.
Okay, Jane, are you with us? Say hello in the chat. So I know you're here in case I need to ask you a couple of questions. Okay, Jane says she has an Airbnb and it's losing money, right?
Mm-hmm. She's here.
Okay, and so read the question again. She has Airbnb, she's losing money.
She's wondering if she should still pay herself management and cleaning fees, or if she should just write them off to her kids instead.
So I want to stop you right there for a second, Jane. I want to first of all ask you a question. Airbnb, is this like on a Schedule E, Schedule C? Like where is it reported? Like what type of entity, what type of income? Is it S corporation? Like it's really, really important before I answer this question. Let me know in the chat. By the way, how many of you would like to win a mug with Boris M Tax logo and your name engraved over here? Your name with our logo. Say yes in the chat. I want to see how many people like this would like this. Why are you laughing? Hey,
It's cute. I like mine.
look at this. Isn't this cool? All right. Jane said personal. Mariana, nobody's responding, so I guess nobody wants our logo mug. Okay. So Jane, that's a. So now here's the thing. When you pay management fee, let's start with A, MGMT fee. Let's start with B. Okay, pay attention. This is actually a great question. Cleaning fee. If you're gonna, and right now your Airbnb, I'm assuming probably is on Schedule E, depending on what you have that set up. I'm not gonna get into detail what type of things you do there, but let's assume it's on Schedule E. Rental, right? If you're paying yourself management fee or cleaning fee, Airbnb is gonna take an expense. Okay, but you still have to pick this up as an income. And you will not most likely, but you will pick it up on a Schedule C as a sole proprietor. And that will be subject to 15.3 extra self-employment tax. So do not pay yourself this. Okay? Do not pay yourself this. Do not pay yourself management fee or cleaning fee. Now, the question is, do I pay my child a management and a cleaning fee? The answer is that is a great strategy. Okay? So you can, as long as they have been managing, if they have been managing, right? And if they have been cleaning the apartment, then you can pay them directly from Airbnb into their account. And you can set up a payroll for the child because this is a self-employment, sole proprietorship type of thing, whether it's Schedule E or Schedule C or whatever that may be. You pay them a fee. You're going to get a deduction here. You're not going to pay any income taxes on what your child receives because it's in a under 13,500. I'm assuming that would be it. So that would be a strategy. But my next question to you is like, are your expenses in the Airbnb tax deductible? Is it a short-term rental? Now, does it meet the definition of the short-term rental? Let's go a little bit deeper over here, okay? So, because it's really important. A lot of people, like I said, they watch YouTube, they watch reels, like, oh, he said this must be true, and they run and do something that is not good for them. So, first of all, we spoke earlier that rental real estate is considered passive loss. Passive loss is not deductible if you don't have a passive income and you're not a real estate professional. Short-term rentals, such as Airbnb, may bypass that rule if you meet the following. You worked, participated in your own rental, 100 hours, actively participated, okay? And really, it has to be more than any other management or any other cleaning lady. So, which doesn't seem like you have. You're doing everything yourself. So, it seems like you meet that rule, okay? Or I think it would also not qualify if your child participates more. Like your child does all the work, your child does all the management, then you won't qualify. But based on the information that you give me on the slide, looks like you meet the 100-hour rule. And if your average stay per tenant is 7 days or less, that means, let's say tenant number 1 stayed 10 days, tenant number 2 stayed 2 days, that's total of 12 days divided by 2, that's 6 days. That means you qualify. And this qualifies as a short-term rental under the definition of the IRS. That means now any loss generated from this is tax deductible. You don't have to be a real estate professional for this, or you don't have to have passive income to be able to deduct this. So I don't know your situation, Jane, but this is definitely a type of a thing you want to speak to your tax advisor about. Cool, next question. And Jane, by the way, let me know if that was helpful. Okay, Jane said, yes, I did meet 100 hours, but longer than 14 days. Oh, longer than 14 days, okay? If the average stay is longer than 14 days, any losses produced from this Airbnb will not be deductible unless, again, you meet the definition of real estate professional. And let me know in the chat if you know what that means to be a real estate professional on the IRS code. And or you have any passive income. Before I go to the next question, I'll give you a minute to respond. Not exactly. Okay, not exactly, you don't know, I'm guessing. Okay, so let me explain to you what real estate professional means. And by the way, you may qualify as a real estate professional. I don't really know your tax situation, but let's break it down, okay? By the way, who said they want the mug with the logo?
Christy.
Christy said she wants one. All right, Christy, you're going to get one. Christy's getting a mug, Mariana. Can we order a mug for her? Christy, you need to email us with your address and we'll have it shipped to you. Okay, cool. Anybody else wants that mug? Cool. Now, Jane, let's talk about the real estate professional.
Oh, wow. Mark wants one and Jane wants one.
But no, we're going to send with your name. Don't worry. It's not going to say Boris. All right. Everybody's on this live. I don't know about everybody. Like 100 people say, I want it.
I want Boris. Oh.
All right. Yeah, I'll send you 2 mugs with name Boris. All right. Real estate professional. Let's get back to business. Real estate professional. Can we send them a coaster also? Because a BM tax coaster. Just look at that. Mariana, she's on the. She's generous today. Usually she doesn't let me spend money. Oh, yeah, I'm just kidding. Okay, real estate professional.
I have your card right now.
Yes. Okay, Jay, let's get back to this. There's 2 tests you have to meet. Test number 1, you have to spend more than 50% of your time in real estate, of your personal services that you provide. So more, right? More, I should say. More than. So I don't know what you do for a living, Jane, but maybe you're managing other real estate properties. Maybe you're managing other Airbnbs, whatever that may be. But more than 50% of your time has to be in that occupation. You don't have to have a real estate license or be a sales agent or qualify for that, whatever that may be. You don't have to do that. You just have to, more than 50% could be that. Second thing, you have to do it for at least 750 hours a year. So IRS says, oh, well, you do qualify for this. You do qualify as a real estate professional. So all the losses, whether it's a short-term, long-term, whatever that is, may be tax deductible to you. Super cool strategy, okay? So what I want you to do, okay, is to see if you qualify with this. But I beg you, I don't have to be a tax advisor, but get yourself a tax advisor, because I feel like you're in a very good position to be able to take advantage of what a lot of people cannot, which is real estate investment strategies. By the way, for those of you that don't know, because we just made up our mind yesterday. We're hosting a 2-hour tax reduction webinar next week on Monday at 1 o'clock. We said no, I changed it to 12.
You did.
Yeah, I didn't tell you. Did you
No.
schedule those emails already?
I'm getting there.
Yeah. No, 12 o'clock. I was able to free up the time.
Okay.
Wait, 1 o'clock.
It said 1.
1 o'clock. 1 o'clock. Sorry. No, you're right. I changed from 12 to 1. All right, 1 o'clock. 2-hour. By the way, I'm going to be talking about the real estate strategies, investment strategies, and things that you can do before year end. For those of you that want to register for that webinar, Mariana, can we drop a link?
Yeah.
Cool. We're going to drop a link. Okay. Jane, is this clear? Let me know in the chat if this is clear. And for those of you that said you want the mug, just email us, and we'll put that email address as well. Perfect. Good. Thank you. All right, let's move on. So while Mariana stepped out to get the link for you guys, we had a question from Christy. Yes, one more in regards of the management company. In order to open the sole prop, I need to use a business address. Should I use a home address? Yep, home address is good enough. Question: Meals and entertainment apply to sole proprietorship? From Captain Planko. Not sure what you mean applied, but as a sole proprietorship, you can deduct meals expenses. Let's see. Okay. Then we've got a question from Patrick. What is the best practice for a single member owner C corporation? Guys, we posted the link to register for the webinar if you guys want for next week. What is the best practice for a single member owner C corporation, photographer, who runs business from home to take the home office deduction, reimbursable accountable plan? That is correct. Patrick, are you here? If you're here, say hello. I want to ask a couple of follow-up questions. Patrick, are you with us? Say hello in the chat. So my first question would be, why are you a C corporation? Yes. Let me know, why are you a C corporation? Okay, Patrick, let me answer that. And then the second thing that you asked in your question is that how do I reimburse myself for home office? You are correct. You reimburse yourself through what's called an accountable plan. Okay, now you reimburse yourself through what's called an accountable plan. Accountable plan is basically a piece of document that says, hey, you, Patrick, your business, whatever it may be, ABC Corp, can reimburse your employees for business-related expenses. Okay, it basically states the stipulation of how the reimbursement should be submitted and the time frame for when they should be submitted and when you should reimburse them. Now, this gives you an opportunity to also reimburse yourself for home office expenses if you qualify for the use of home office. Okay, if you have an exclusive area and if you have another location that you work at, but you said you are a photographer, so I'm guessing you're working from home. Okay, you probably have a studio and stuff like that. So you qualify for home office. Now, what you need to do is basically submit a reimbursement sheet every month. Okay, and you need to be reimbursed on a monthly basis. Now, generally, the stipulations of an accountable plan says that employee has 60 days to submit the reimbursement report, and the business has 30 days to reimburse them. So the business will reimburse you for the use of your home office. If you rent for $1,000 a month, your home office is 10% of that, and you pay $1,000. So the business will reimburse you $100 for your home. That could include utilities. That could include the cleaning lady that comes to clean either the entire house, which includes your studio, HOA fees, insurance expenses if you own, mortgage interest, property taxes. But yes, that will be done through an accountable plan. I hope that's clear. And you said, and you said you're in a high tax bracket due to husband W-2. Okay, so you're saying that you're in a C corporation because your husband is a high, because you're in a high bracket due to your husband's W-2. I don't know if I buy that as a strategy. I'll explain to you why. Like, how high of a W-2 is it? Okay, because remember, I have recommended C corporation in the past before. Don't get me wrong. It's a strategy, especially if you're going to be investing and whatever that may be, and you're in a very, very high income bracket. But money in the C corporation is trapped. The only way you can take it out, you can either take it out as dividend distribution, which will be subject to double taxation, or you can take it out as salary. I would tread the waters very carefully with a C corporation. Okay. Now, another rule of a C corporation states that you have accumulated earnings, accumulated earnings and profit, right? AEP. There you go. AEP, which is your retained earnings, the cash that you made, just keep in a C corporation, paying it a lower tax. So if it accumulates $250,000 AEP, IRS is up. You got to pay dividend tax on it, or AEP tax, excuse me. I think it's accumulated earnings and profit. Yep. So I think it's 20% if I'm not mistaken. So really must have a strategy. Okay. Definitely talk to your tax advisor about this. I would be concerned about this. Okay. Patrick, I think we answered all that. And
Captain.
read all my comments for complete question. Well, Captain.
Yeah, I have it.
You have all the complete questions for Captain Blanco. Let's go.
One person equals 100%. Ordinary and necessary, not lavish, extravagant, business-related, categorized as supplies as it's under $200 and or more maintenance. Also, revenue qualifies as owner's equity. Is meal 100% deductible? If no, why not?
Yeah, I'm not. I haven't understood the entire question, but I will answer your meals question. Meals are 50% tax deductible. Why not? I don't know. Ask the Congress. Okay. When we had COVID, they did make meals 100% tax deductible to help the restaurant owners. That deduction went away, so now it's 50%. And I think we answered everyone's question. We're also cutting it close to our time. For those of you that said you want to receive the mug, it was Mark, Christy, Jane, I think, right?
I believe so.
Yeah. I think it was Mark, Christy, and Jane. So
we got another question coming.
Yeah, Christopher, A&E tax is 20%. Correct. That's okay. I forgive you. Yeah, you can fact check me anytime. I do make mistakes too. Okay, cool. All right, guys. Thank you so much. We're gonna end this live.
You were saying about the mug.
The mug, yes. Guys, email us. Do you want to put their email address? So.
Yeah. Can you just?
What do you need, the mouse? Yeah. Oh, let me put it in for you. All right. Thank you very much, everyone, for attending. And we'll do this on a weekly basis. Not next week. Next week is Thanksgiving, right?
Yeah.
Guys, for those of you that haven't registered for a 2-hour tax reduction webinar, we're going to be covering a lot of tax strategies and year-end planning and year-end strategies. It's going to be next week, Monday at 1 p.m. Eastern time. So definitely want to show up for that. I think we're good. And for those of you that are interested on working with us on your tax advisory, we're also including a link where you can schedule a call with my team. And yep. And I think that is it. You're welcome, Mark. Okay. I think we gave you all the links. You're welcome, Jane.
Oops, I wrote if you want a live. I meant if you want a mug. Also. Foggy brain today.
Yes, if you want the mug, email the email address. Jane, do you want the mug to say Boris or Jane? Just ask.
Let us know what you want the mug to say. Otherwise, everyone's
I'm
gonna get
kidding.
a
I'm
Boris
kidding.
mug.
Yeah, we'll do it with your name. Okay, guys, thanks so much. Till the next time.